but we're going to go ahead and start. Today's education series webinar, Profit Systems in Real Time, learn how to use the MetaStock System Tester to boost your trading profits. We're excited to present Robert W. Colby, CMT. Before we start, as we usually do, I need to read down our standard disclosure. If you'll bear with me for just a moment as I read this. This demonstration is designed to instruct you on using MetaStock software and accompanying plugins. It is not a recommendation to buy or sell exchange-traded instruments, but rather guidelines to interpreting and using specific indicators and features within the software. The information, software, and techniques presented should only be used by investors who are aware of the risk inherent in trading. Thomson Reuters shall have no liability for any investment decisions based on the use of their software, any trading strategies, or any information provided in connection with the company. Okay, thank you. I appreciate you hanging in there with me for that. Robert W. Colby, CMT, is founder and chief investment strategist at Robert W. Colby Asset Management Incorporated, a New York registered investment advisor. And Mr. Colby is a world-renowned expert with 43 years of professional investment experience. He has been using MetaStock intensively for more than 20 years. He used it to develop many successful strategies that he uses today. To manage his clients' portfolios, he used MetaStock exclusively to test hundreds of different indicators and systems for publication in his 2003 book, The Encyclopedia of Technical Indicators, his second edition. What else can we say? There are few people on the planet who know as much about technical analysis than Robert, and we consider him an incredibly good friend over here at MetaStock. It's really a pleasure to introduce him to you. And so I'll go ahead and turn the time over to you, Robert.
Thank you, Dave. Can you see my screen? Great. All right. So I thought a good topic would be how to use the MetaStock System Tester to boost your trading profits. It's an incredible tool, the System Tester, and you learn things about the way markets are, where they really are. And a lot of people, they'll read something in an old dusty book and they'll try to trade on that, but the markets are always changing, and what worked in the past, as we will see in this presentation, things that worked in the past don't necessarily work currently. So you always have to be on top of the changes in the market and the mood of the market, the mode that it's in. Is it trending? Is it choppy? Is it is it continuing trends, or is it reversing trends? And each market has its own personality, and you can use a system tester to tell you what the personality of the market you're interested in trading, what that personality is. And in this topic today, I'm going to talk about what systems work best for forward trading, show you how to find that, show you how to find what specific instruments your systems work best with, show you how to use the powerful MetaStock System Tester complete with working code and settings. And I'm going to offer you a companion report, which is basically this report with all kinds of details. Actually, it's this report plus a little extra. You're going to get this report absolutely free by going to by emailing me, and you can have the code so you can independently verify findings, and you're going to have an opportunity to have a free trial to my weekly research reports. Okay, next page here. This is a standard disclaimer, pretty much. Hypothetical and simulated performance has certain drawbacks. It's not real. I'm going to discuss that. That's a very important point, actually. And nothing I say here is should be taken as investment advice or as a recommendation to do anything in particular, to follow any particular system. Like I said, the markets are always changing, so you have to be on top of them. All right, the old masters in the old dusty books that we've all read and respected told us the trend is your friend. And that certainly used to be true. Many people still think it is true. Most of the market wizards, in fact, made their fortunes by trend following back in the 70s and 80s. There were tremendous upswings in commodities, gold, wheat. In the late 70s, oil went, skyrocketed up fourfold. Actually, more than that, I think. And also in the 80s, the currencies were trending very well. And a few of the market wizards made their fortunes trading currencies. They were trending. But maybe not so much anymore. Let's look at let's test the S&P. I'll show you there at the bottom what I'm testing. I loaded into MetaStock System Tester 115 years of S&P data. I use the SPY from the ETF SPY from its beginning in 1993, and I spliced onto that a 10-for-1 adjusted S&P. And actually, before 1950, I spliced on the Dow Jones Industrial Average. So I've got a continuous history of 115 years of stock market, basically. And when I ran System Tester to see which EMA exponential moving average crossover would have worked best, using squares of numbers, I got this output, and you can see here that the square of 2, the square of 3, and square of 4 maximized profits. I'm going to show you some more here. Next page. So 2, 3, and 4 are the most profitable, and as the number increased, in other words, square of 5, square of 6, and so on, profits decreased substantially just with this moving average crossover rule. Now here's the code. You put it in System Testers by order. Year is greater than 1896 because my data starts in 1897. The close greater than moving average of the close opt1 times opt2. That's a square of a number. You put in there, I put in from 1 to 18 as opt1. I'll show you a screen that shows you how to do that. And it's exponential moving average. That's what the E means. And we're going to sell short when the close is less than that moving average. So it's a very simple rule. And we're going to start with these are the System Tester settings I used. And I use the same for all the presentations here, the same settings. You can change these settings in various ways, but for purpose of this presentation, I wanted them all the same so we can compare systems against one another using the same exact settings. It's just to keep things simple. So we start with $100,000 initial equity. We're going to trade 100% of our equity. We're going to go both long and short. Our broker options are interest rate 0, money market 0 for this purpose. Margin requirements this is a little tricky screen. It was given to me by a MetaStock person. This is the same as trading cash without leverage. Set your initial margin requirement to 100%, long maintenance 0, short initial 200, short maintenance 101, which doesn't really make sense, but that's what makes it like trading a cash account. Commission 0, exit 0, just to keep things simple. And you can again vary those numbers. System testing options. We're going to buy, sell short, and buy to cover all at the close of today. Now, people say I'm going to delay opening of 0, so we're going to execute on today's close. And We'll have a slippage of 0 also. Now, people might object and say, well, you can't really, how are you going to execute on today's close because you need today's number to trade on the close? Well, you can run your numbers at quarter to 4 Eastern time, or even 3:55, and anticipate where the close is going to be. It's not really an issue. Now, here are results zooming in, and we're going to try it without squares. We saw that square of 2 to square of 4, that'd be 4 to 16, maximize profits. Now let's just use actual numbers. Now with an EMA, crossing 1, it doesn't give you anything. It doesn't give you any result. But crossing 2, as you can see, returned the highest profit of all the other settings. Setting 15, for example, was the lowest return. So as we kind of went out in time, irregularly, but the profit wasn't as good. So a very simple crossing of a 2-period moving average and executing on today's close would have made the most profit over 115 years. And there's the code. It's the same as before, except there's no opt1 times opt1. It's just opt1 because we're not using squares and numbers. But using squares and numbers is a very fast way to trade a lot of numbers in a progressive fashion. In other words, you can trade from a very short moving average to a very long one in very few passes. All right, now let's look at the equity line. You draw this from the system tester. It will draw it on the chart in the lower left-hand corner. You just click plot, and it draws this equity line chart. This is how your money would behave. So starting in 1879, each dollar would have grown to $360,000. There would have been over 10,000 trades, and about 40% of them would have been profitable, which isn't bad for a trend-following system. So this sounds too good to be true. Well, it is true, too good to be true, because the devil's in the details. If you notice over to the right of the screen, and when you get your PDF, you'll be able to zoom in and see this very clearly. So don't worry about it right now. And don't worry about taking notes, because it's all in the PDF. Everything I'm going to tell you is in the PDF. So since the year 2000, you can see that profit has gone down over there in the last 2 inches of your screen. Profit's gone down, down, down. As a matter of fact, it's been a losing strategy since year 2000. So trend following on the S&P is no country for old men who try to trade the way they used to trade before year 2000. The markets have not been trending. The stock market, that is. That doesn't mean all markets, as we shall see. We find that I found that the EMA2 crossover would have been profitable for the agricultural commodities over the past 15 years, but it would have been quite unprofitable for most energy, financial, and metals futures markets. Let's look at the 24 futures markets using 4 different systems and see which systems worked best, and the details will follow. Again, I loaded in data for on 24 futures markets for 15 years, from 1988 to a couple of days ago. And here we see EMA2. It worked for bean oil and lumber and the agricultural commodities. But it lost money down here in the lower half of the screen on currencies, bonds, and the S&P futures, and also energy and natural gas and the Nikkei. The Nikkei, the Japanese market, and also the British market, the Financial Times. And I've highlighted in yellow the S&P, which is probably most interest to most MetaStock users, I think. So there's the actual performance. EMA2. Now in the next columns, I looked at a long-term MACD, which I will describe as we go along here. And you see that was really pretty profitable. Gold was the most profitable, 377%. S&P would have been profitable using MACD, a long-term one. Copper, heating oil, Nikkei, Financial Times, crude oil, CL, silver, all profitable. And quite unprofitable would have been the agriculturals at the bottom. RMO is a very popular indicator in MetaStock, and it made money also, like EMA2. It's sort of a medium-term trend following, and it made money in the agriculturals, just like the EMA2 did. And RSI then, RSI and EMA combination, which I'll describe in detail a little later, made money in the financials and also the energy. So, depending on which market you're trading, you need a different system. That's all we can conclude right now, and I'll show you more details here. Okay, let's look at some of the details on this EMA2 crossover, 2-period EMA crossover. This is very fast trend following. That's what that fast TF means, fast trend following. It's about the fastest you can get, basically. And it worked for soybean oil, lumber, rapeseed. It worked very well for agriculturals, but it didn't work for any of the energy. Or the precious metals or copper. Very poor performance. S&P and the bonds. And notice in the trade PL, that's the number of winning trades, number of losing trades in those columns. You have a majority of losing trades with fast trend following. In all markets, there's no market where the number of winners outpace the number of losers. So you get a lot of whipsaws, but the trend is your friend in those agricultural commodities. Let's look at the S&P futures on the 2-period EMA crossover. And the time here is the 15 years. And again, you can zoom in when you get the PDF, and you'll see that equity peaked in year 2000. And it's down actually 52% since the beginning of 1998. So you don't want a short-term trend follow trading the close in the S&P futures. Just not a good strategy. It's going to lose money. Well, it's been losing money. All right, let's look at the medium-term trend following with RMO. And here's the code, the buy order code followed by the short order code. Now, you don't really need to, you can leave your cell blank because this is what would be called a reversal system. You're either long or you're short. And so when you're no longer long, you're short. When you're no longer short, you're long. So you don't really need to fill in the boxes for sell or for buy to cover. All right, this is the code that Dave mentioned in a previous MetaStock seminar, and it actually works better than RMO above or below zero by itself. To add the swing trade in there actually improves performance with the S&P. Okay, so again, you see that the agricultural commodities did the best with the medium-term trend following, just the same as the short, pretty much. Whereas but some of the eggs there at the bottom, and that's wheat and live hogs, they actually lost a bundle with medium term. They did better with short term. But again, your financials and your energy didn't do well with the medium-term trend following. So that's pretty useful information, I think. Now let's look at long-term trend following using MACD. I got a link here to Wikipedia, which describes in pretty good detail MACD. It's a tremendous indicator. I recommend that you study it. It's tremendous because you can modify it, and I'll show you how to do this, to modify it to fit any data, any market, any time frame, which is pretty incredible. All we have to do is vary the default settings of EMA 12 days minus EMA 26 days. We can vary that any way we like by using the code I'm going to show you. Generally, MACD works, I've found through lots of testing, MACD works better when the longer EMA is 2 or 3 times the length of the shorter EMA. Now, if you want to test a market, an instrument quickly, searching from very small numbers to very large numbers, you can use squares as follows. And here's the code. By order, you can enter any year you want. When the year is over a certain date that you can pick, and the moving average of the squared exponential moving average is greater than itself times 2. Up to is set at 2 in this case, or you could set it at 2 or 3, and then see which one works best for the particular market. So, and the short order is just the opposite. The moving average, the faster moving average, up 1 times up 1, is lower than, less than the longer moving average, which is that first one double the length of the first one. So in this example, I set the opt1 from 1 to 18, step size 1. Opt2, I just kept it 2. And this code I just show you here allows you to quickly search in just 18 passes, and it goes very fast on the computer, using progressively larger steps for an MACD as small as EMA 1 period minus EMA 2 period, which is what we saw with the EMA 2 crossover, because EMA 1 is just the close itself, and as large as EMA 324 minus EMA 648, which are the squares of 18 and 18 times 2. That is, you can quickly search from extremely fast and sensitive oscillators to extremely slow moving oscillators that respond only to major moves, and you can see which one works best. In other words, is a market you have to trade it quick, or can you trade it slow? Which works best, or somewhere in between. The MetaStock System Tester will tell you using this code. Okay, looking at this SPY data, the S&P ETF, over the years shown from 1997 to a couple of days ago, here's what we found. Look at the column called Opt1. You can see that the very short ones lost money, which we already knew from our EMA 2 crossover. And profits went up and up as the length increased to a maximum there at 12. Returned 332.5%. If you graphed that out, that's what it would look like. This is our system development results, okay? And with 12 there being the highest profit, what this means is shown there at the bottom. the best setting 12, that means EMA 12 times 12 minus EMA 12 times 12 times 2, based on the code I showed you, is the same thing as an EMA 144 day minus an EMA 288 day. Okay, 288 days. Very simple idea, but this is what we found in just minutes of testing with the system tester. We found that a longer term oscillator, MACD type oscillator, with a very long term moving averages, maximize the profit for the SPY since 1997. And here's what the equity curve would look like in the development period. In other words, with the data we loaded in, this is what the equity curve would look like when you plot it on a graph. And it's pretty promising looking. It's heading up. It's rising. There's some drawdowns, but they don't look too bad. It looks like it made a lot of money. Oh, this is a ratio scale, by the way, semi-log scale. So it's a pretty strong looking result. Unfortunately, it's not realistic. So in our development, the results look promising, but you got to realize that since we used the data to fit the oscillator to, it's not realistic. We already used the data, and we're not supposed to do that in our realistic testing. So we used the latest 16 years of data to develop our MACD setting. How can we do our walk forward blind simulation? Do we have to just wait for time to slowly pass day after day in order to see how the system would perform on unseen data? That's the gold standard. How does it perform on data that you didn't use to develop the system? That's called unseen data. No, we don't have to wait. Introducing Colby's walk backward blind simulation. This is something I've been toying with. I don't hear anybody else talking about it, but it certainly seems sensible to me. So we use the recent data to develop the system. Why not look at the old data before we develop the system to see if it worked on that old data before we trade it? Either walking forward or walking backward. Blind simulation on unseen, unused, fresh data can reveal strengths and weaknesses of a system. If a system doesn't work on unseen data for a particular market, then you really can't trust it. And you can see with the unseen data a more realistic portrayal of how the performance might actually be. So what we did here is we used data from 1997 on to develop the system. So we're going to look at 100 years of data from 1897 to 1997, and we're going to use that S&P cash index plus joined to the Dow Jones Industrial Average to see how this system would have performed over 100 years. And there's our result. Each dollar put in the system to trade the system on the stock market would have grown to $20 over 100 years. Of 69 trades, 29 would have been profitable. That's a 42% winning trade, which isn't bad on unseen data. But you got to look out for the wartime drawdowns. It looks like every big drawdown coincided with war. 1914, 1938, 1962, and 1990. Now, war causes a lot of nervousness and a lot of unforeseen news headlines. So also, you get into a big war and and not everybody, you know, is confident what the outcome will be. I mean, there's always a chance that some substantial damage could be done to business and to stocks. So it really unsettles the market, and you can see how crazy the market got around war times, particularly back in the late 30s. That was like one of the worst times for any kind of trend following. I have looked at that period using all kinds of indicators, and they all kind of go wild back in the late 1930s, just before World War II, and also in the early part of the 1940s. All right. So, excuse me, I twitched a little fast here. Okay, so let's take a look at testing this MACD on unseen data for the same futures contracts we tested before, and we see that the long-term trend following using MACD worked well with the futures that worked poorly with the short-term trend following. Okay, so that's pretty useful information. So like gold, S&P, copper, heating oil, and foreign stock markets work better with long-term trend following, whereas your agricultural commodities don't work at all, really, with long-term trend following. They work with short-term trend following. Also, trend following appears to work in bull markets in general, but it doesn't work very well in bear markets or sideways markets. So what do we do when trend following is not working? I addressed this question 7 years ago in an interview with tradingmarkets.com. Eddie Kwong asked me some questions and about how to, what indicators were performing best with the stock market in recent years. This was again October 2005, and I said then that some of the oscillators, the overbought oversold kinds of oscillators like CCI, RSI, and stochastic, were doing the best. And particularly if you filtered them with a long-term trend moving average, so that you didn't really go against the major trend. In other words, you're trading with the major trend, but you're buying oversold in a bull market, and you're selling overbought. And in a bear market, you'd be shorting overbought and covering oversold. And I said then, and this is direct from the article, which is on robertwcolby.com, the link. Oh, actually, the link's right there. The whole interview, I described this RSI indicator filtered by a long-term moving average. And you can read the whole article online. So what I did for this presentation is I recreated this RSI system using the same data that I used that I talked about in the article. In other words, I used the S&P futures contract. This is Reuters Data Link data for 23 years, from 1982 into October 2005. I loaded that in, and this is my development set. So from here, we're going to find out. I'm going to show you how I found this RSI 3 with a filter, EMA filter. I'm going to show you how I found this. So if you load this in, this data in, this is the results you get, and you see that a 3-period RSI would have maximized profits, but all RSI lengths from 2 to 14 generated profits. But the profit was maximized with 3-period RSI. And then for the filter, crossing EMA, a long-term EMA, you see as the EMA length increased from 1 to 400 in step of size of 10, that as it increased up to about 420, profits increased steadily with this system. As it went beyond, as you increased the EMA length beyond 320, profit dropped off some, but not bad. Let me see here. This is the equity curve in the development set of data. Again, it's not realistic because I used all the data from 1982 to 2005 to develop the system, but it looks promising. It looks like we have possibly a system we could trade. Now, we want to know is how would this have performed real time since 2005? In other words, on unseen data that we didn't use. And the way we find that out is by the walk forward blind simulation. We have data from late 2005 to this till just now. We have unused data, unseen data that we can walk forward with and test. And here's the code. Here's the code. As you can see, I'll let you read that in the PDF. You just can copy that right into your MetaStock System Tester. But basically, it says you're buying an RSI that's oversold with the RSI 3-period less than 30, and the close above the 320-period EMA. And we're going to sell when the RSI is overbought above 70, or the close is below the 320-period EMA. We're going to sell short when the RSI is overbought and the close is under the EMA. And we're going to cover our short when the RSI is oversold or the close is less than the 320-period EMA. That's the code that we use in System Tester. For Opt 1, we set it at 3 because we found that was the best. And for Opt 2, the EMA length, we set at 320. And here's the key question is, how would it have done in a blind walk-forward simulation on unseen data? 2006 to a couple of days ago. Well, it made money, but you can see that it was a rough ride. The system would have made money on most of its trade, was with 55 winning trades, only 27 losing trades. But it got roughed up pretty badly, particularly in the flash crash of 2010, May of 2010. The market was way above the 320-period moving average, so when it started to come down, RSI got oversold, but the market continued down. And it was so far above the moving average that it didn't cross the moving average in time to save your money. And there was a rather hefty drawdown. It would have been hard to stay in, or hard to take that huge that big drop in equity. That's your money, and it'd be hard to sit through that. So you might want to experiment with stops when you use this kind of system. Keep in mind that currently EMA 320 may not be the optimal one anymore. You might want to update using this code for more recent data in a new development. But the point is that the system does work, or did work, I should say, in walk-forward testing, but it was very, very volatile, and therefore I think that it needs some kind of stop. Fast moves against the trend hurt you. If the price is too far away from the moving average. So it's generally true that a big fast directional movement, either up and down against established trend, as defined by a longer term moving average, will produce losses for trend fading, overbought, oversold systems. Because again, when the market, you're using a fast overbought, oversold system, like as soon as it starts down after a day or two, you get an oversold right away. And if the market keeps going and it's far above the moving average, you're going to be on the wrong side. Luckily for those who like to fade the trend and be right most of the time, because most of these signals are profitable ones, the market spends most of its time in a choppy mode, and that's why a system like this has a majority of winning trades. 67% in the walk forward, 67% winning trades in the walk forward simulation here. Okay, so finally, and we're getting towards the end of the presentation here, let's compare all four of these systems we've disclosed: the EMA2, the medium-term RMO, the slow MACD 144-288, and the counter trend RSI 3, overbought, oversold, with a 320 period filter, moving average filter. We're going to compare these against a list of 143 liquid, active, and diverse ETFs using daily data for 15 years. And we're going to see which systems really worked best on these ETFs, which I know are of great interest to a lot of traders these days, for good reason, because they're good to trade. Okay, so here are the summary results. I'll show you more details in a minute. It looks like when you look at the median gain for all 143 ETFs, the median gain was maximized with RSI 3 with a 320 filter. That's overbought, oversold with the long-term trend filter. Coming in second, MACD did fairly well. Again, these equity markets, they like the long-term trend following. The medium-term trend following, the RMO, produced a lower profit. And finally, the very fast short-term trend following, EMA2, lost money on 143 ETFs in 15 years. Now, if you look at the average profit of trading these systems, you get a slightly different order. RMO produced a larger average gain thanks to a few ETFs that worked extremely well with RMO, even though the majority didn't. RSI came in number 2 with the average gain, pretty good result. MACD much lower, and finally the counter trend trading with the EMA. The very fast trading with the EMA2 crossover performed the worst again. Okay, so here's EMA2. Here are the top 10, bottom 10 of the 143 ETFs over 15 years and the results. So the EMA2 worked well with the metals and mining spider, financial preferred, another preferred, Brazil, Latin America, etc. And it performed very poorly with a lot of these foreign equity markets. Okay, they did very, very poorly. So short-term trend following, very poor for equity markets, and possibly promising for a few others. On the PDF that I'm offering by email, you can see the entire list of 144. See which ones worked and which ones didn't work with the MA2 crossover. Okay, the RMO worked extremely well with the India ETF, EPI, and the Brazil index in Singapore, Latin America, Austria, but it worked very poorly with the with the metals and mining, which did well. As we just saw, the metals and mining did extremely well with the very fast short-term trend following. It did very poorly with the medium-term trend following. Let's look at the long-term trend following. Again, you can go through this. I'm going through these quickly, but you can study these at your leisure. And this is the kind of, my presentation is the kind of thing you're going to have to, study a bit because it's a lot to absorb. So the MACD is with this setting, 144 period minus a 288 period crossing zero. That's a very, very slow indicator. So you're looking at major trends only here. And what did well? Trading very slow major trends. Well, gold shares. Gold has been on a tear for a long time, and it produced a tremendous gain, and the best of all instruments, all 143 ETFs. India did pretty well. India did well again. Remember on the RMO back here. Wait a minute, is that where's that India at? Oh yeah, India was number one with RMO. That's medium-term trend following. Well, it did okay on the. It did quite well with the MACD as well, the long-term trend following. It was gangbusters on the medium-term, but that was an incredible number. Okay, so the REITs, the spider worked well with MACD. Well, it should have, because we actually optimized MACD on the spider. That should probably be thrown out. That's what you call seen data. But the rest of these are unseen data. REIT did well with MACD utilities. And what did poorly with long-term trend following is networking, oil, again a commodity. Oil did very poorly, metals and mining with long-term, and the metals and mining did well with short-term, as you recall. And then finally, the overbought oversold RSI with a long-term, what you call permission filter. The price has to be above 320 before we go long, or below 320 before we go short. The overbought oversold worked well for these top 10 markets, and it looks like a few of the foreign markets which did poorly with trend following. And then it worked very poorly, overbought, oversold, with those strongly trending markets. Again, there's India down there. Okay. Now, when you ask for the... Oh, yeah, okay. Well, let me just quote Mark Twain here, because this is a very true quote. He said, It ain't what you don't know that gets you into trouble. It's what you know for sure that just ain't so. And this couldn't be more true than it is in the stock market, because as I said, those dusty old books tell you that you have to trade trends short term, and as you can see, that doesn't work for a lot of things. And with the S&P, for example, the trading short term trend would have got you into big trouble. We just saw that, and the data prove it. So with System Tester, you can prove things whether they're true or false, and the data doesn't lie, and you learn things by testing. Okay, so brief description here of what I do. We have Robert W. Colby Asset Management is a New York registered investment advisor. We have our separately managed, and I emphasize our clients' separately managed accounts. Each client has his or her own account. We don't commingle anything. Everybody has their own account, and they can look online to see their account at any time. They have a lot of control over their own money. But our separately managed accounts have made money on 6 of the past 6 quarters, while the S&P made profits only 3 of the past 6 quarters. For the full year 2011, our clients gained 8%, while the S&P ended down slightly. We provide active professional management. We perform continuous daily and intraday analysis and management. We can quickly change our strategy to take advantage of opportunities or preserve capital. Bear market protection, which I can't overemphasize, because most money managers will just go down with the ship. When the market goes into a bear market, if the market's down 50%, they're going to be down 55, 60%. As many of you have found out, I'm sure. They don't really even try to get out of the way of the tsunami bear markets, but we do, and we're on the job 24/7, 365 practically, and if we get into a bear market, we're going to protect our clients. We're not going to let them go down with the ship. We're going to do everything we can in our power to make sure our clients don't have a devastating loss in a bear market, which, bear markets come every 4 years roughly, and so we believe we should be prepared for that. Be prepared for the normal market cycles. Our flexible approach is similar to what some of the best hedge funds use, only we don't charge high fees, the high hedge fund fees, and we have much lower risks than a lot of the hedge funds. A lot of the hedge funds also will go down with the ship. If you look at their performance, not much better than mutual funds in recent years, but in big down markets, a lot of those hedge funds will lose money as well. We manage trusts, we manage RIAs, 401k rollovers, and brokerage accounts. So give us a call or go to our website if you would like to find out about our money management services. Also, email us at info@colbyassetmanagement.com to get a copy of this PDF. And I'm not going to cover the details here of the 4 systems on 143 ETFs. I'm not going to take time to go through this, but it shows you all 143 ETFs and their performance on all 4 systems. So you can study these tables and get an idea which ETFs work with which systems and which don't. And that's again, I think that's very important information that can make a big difference for your investment and trading results. So that, oh yes, when you email us at info@Colby Asset Management for this PDF, just type in the subject line MetaStock, and we will send you promptly this PDF, no obligation, absolutely free. What else? There was something else I had in mind. Oh yes, well, yeah, anything about our business, just email us, or you can look at our emails or call us at the phone numbers at the bottom of the page here. We're glad to have new clients. This is how we make our living. We're doing our best for our clients, using all our tools available. And we thank you for listening. It's been about an hour, and I appreciate your patience. I know this is not easy material, and that's why I created this PDF, so that you could review it, study it, and this will help you. This code will help you launch your own studies. You can find out what works and what really works and what really doesn't work. You can find out for yourself before you risk your money. So that concludes my presentation. And again, I thank you for tuning in and giving me an opportunity to show you some of my work.
Thank you, Robert. We so appreciate you taking time to join us, and I learned a whole bunch today myself. I really appreciate the PDF that's coming. If you would, go ahead and put that splash screen back with the phone number and the website, and we'll leave that up for the folks so they can take down that information. And certainly we want to encourage all those in attendance today to go ahead and make contact with Mr. Colby. Call the number there and visit him on the website, or definitely send them a direct email so you can get a copy of these notes. Once again, thanks for taking time out of your schedule today to join us, and thank you for a fantastic presentation, Robert. Everybody have a great evening.